Welcome to Gold Cipher. Today we cover the 10 red flags that most commonly draw IRS scrutiny, how the IRS actually decides which returns to examine, what documentation protects you, and what to do if you receive an audit notice. By the end of this video, you'll understand exactly what the IRS is looking for and why a well-prepared, accurately documented return has nothing to fear. Before the red flags, let's establish the reality of IRS audits. The overall audit rate is less than 0.4%. That means more than 99.6% of returns are never audited. Your baseline odds are strongly in your favor. But that low average doesn't apply equally to everyone. Certain return characteristics bring the probability far above the national average, and those are exactly what this video covers. When an audit does happen, over 75% are correspondence audits handled entirely by mail. The IRS sends a letter asking for documentation on one specific item. You respond by mail with a supporting document. That is often the complete audit. No in-person meeting. No IRS agent at your door. The IRS audit window is normally 3 years from the filing date. But if you underreport income by more than 25%, that window extends to 6 years. For fraud, no time limit. The best defense against an audit is the same thing that makes you a good filer anyway. An accurate return where every deduction is supported by documentation you can produce on request. Red flag 1. Unreported income. This is the IRS's #1 automatic trigger, and it requires no human decision. The IRS receives copies of every W-2, 1099 NEC, 1099-K, 1099-V, 1099 INT, and 1099 DIV issued in your name. Their computers automatically match these against your return. If your reported income is lower than what their records show, a mismatch flag fires automatically. The fix is simple. Report every dollar. Forgot a 1099? File an amended return before the IRS contacts you. Self-employed income with number 1099 still counts, reported on Schedule C. The IRS also receives information from banks, investment platforms, and gig economy companies. Red flag 2. High income. Audit rates rise sharply above $500,000 in reported income and are significantly elevated above $1 million. This isn't a trigger you can eliminate, it's a reality to be aware of. The IRS devotes more resources to higher income returns because the potential revenue at stake is larger. The response is the same at any income level: meticulous documentation and an accurate return. Higher income filers benefit significantly from professional tax preparation and year-round bookkeeping. Red flag 3. Unusually large Schedule C deductions. The IRS uses an automated scoring system called the DIF, Discriminate Information Function, that statistically compares your return to similar filers with similar income in similar industries. If your deductions are dramatically higher than the average for your peer group, your DIF score rises, and so does your audit probability. High home office deductions, large vehicle expenses, high meal and entertainment claims, and significant miscellaneous deductions all draw scrutiny. The solution is not to avoid legitimate deductions, it's to document every single one so it can be defended. Red flag 4. Claiming losses for multiple consecutive years. The IRS hobby loss rules disallow deductions for activities not engaged in for profit. 3 or more years of consecutive losses raises the question of whether your activity is a business or a hobby. Hobby losses are not deductible. Business losses are. The distinction comes down to conduct and intent. Do you operate professionally, maintain separate books and bank accounts, spend significant time on the activity, and have a realistic expectation of future profit? Demonstrate business intent with written business plans, dedicated accounts, and organized records. Red flag 5. Excessive charitable deductions. Deductions disproportionate to your income are a known audit signal. For cash donations, keep every bank statement, canceled check, or written acknowledgement from the charity. For non-cash donations over $500, Form 8283 is required. For items valued over $5,000, furniture, artwork, vehicles, a qualified appraisal from a certified appraiser is mandatory. Without it, the deduction can be fully disallowed. Clothing and household goods must be in good used condition or better. Red flag 6. The home office deduction. This is a legitimate and valuable deduction, but it is heavily scrutinized. The IRS rule is strict. The space must be used exclusively and regularly for business. A guest bedroom with a desk that occasionally doubles as a workspace does not qualify. A dedicated room used only for business administration does. The simplified method gives you $5 per square foot up to 300 square feet, a $1,500 maximum deduction with zero depreciation tracking required. Do not avoid this deduction if you genuinely qualify. Document the exclusive business use clearly. Red flag 7. Claiming 100% business use of a personal vehicle. The IRS is highly skeptical of this claim. A car used exclusively for business and never for commuting, personal errands, or personal trips is genuinely rare. Log every business trip, date, destination, business purpose, and miles. Business miles divided by total annual miles gives your legitimate percentage. The IRS specifically asks on Form 4562 whether you have written mileage records. A contemporaneous log kept throughout the year is far more credible than one reconstructed at tax time. Apps like MileIQ or TripLog Autolog in the background. Red flag 8. Cryptocurrency. The IRS has invested significantly in blockchain analytics tools to trace crypto activity. Every sale, trade, or exchange of crypto is a taxable event, including trading one cryptocurrency for another. The question about digital assets appears on page 1 of Form 1040. Answering no when you had transactions is a significant risk. Use crypto tax software to generate accurate gain and loss reports. Losses can offset gains. The IRS treats crypto as property, not currency. 3 more flags. Red flag 9. Round numbers throughout your return. Real business expenses are specific amounts, $1,247, not $1,000. A return filled with round figures signals to reviewers that expenses were estimated rather than tracked. Keep receipts and use actual dollar amounts every time. Red flag 10. Prior audit history. If your return was previously audited and adjustments were made, the IRS is statistically more likely to examine subsequent years. Consistent, accurate filing and complete documentation reduces this risk steadily over time. Bonus flag. Incorrectly claiming refundable credits. The Earned Income Tax Credit and Additional Child Tax Credit are the most commonly fraudulently claimed credits. The IRS has specific automated verification procedures for both. Claim them only if you genuinely qualify. Penalties for improper claims are substantial. And the single biggest audit trigger of all: not filing. Unfiled returns are tracked. The IRS issues a substitute for return on your behalf, which is almost always far less favorable than filing yourself. Always file on time, even if you cannot pay the full amount owed. The DIF. Discriminate Information Function. It is the IRS's automated scoring algorithm that has been in use since 1962. When you file, the algorithm compares your return against a statistical model built from millions of similar returns in the same income range, filing status, and industry. Every return receives a DF score. Returns with scores significantly above average for their peer group are selected for review. This is purely mathematical, not a human making a personal judgment about your return. What moves your score up? Deductions significantly above the peer average, income patterns inconsistent with prior years, Schedule C expense ratios far above industry norms, and specific line items with known fraud profiles. What the IRS does not know is your documentation. They see the numbers, not what's behind them. A high DF score is not a problem on its own. A high DF score with thorough documentation resolves quickly. A high DF score with missing or inadequate documentation creates a difficult audit. The prescription is simple and consistent. Keep every receipt, log every mile, and document every deduction. How long to keep your tax records? The baseline rule. Keep all tax returns and supporting documents for a minimum of 7 years from the filing date. Here's why. The IRS normally has 3 years to audit. The extended window for underreporting is 6 years. 7 years gives you a meaningful buffer beyond both. Specific categories: tax returns and all attachments, 7 years minimum. W-2s, 1099s, and K-1s, 7 years minimum. Receipts for deductions, 7 years from filing. Business mileage logs, 7 years. The IRS specifically requires written records. Property records for your home or other assets, keep until sold, then an additional 7 years for capital gains purposes. Charitable donation receipts, 7 years from filing. Business bank statements, 7 years minimum. Digital is fine. Scan everything. Cloud backup ensures records survive beyond a hard drive failure or a house fire. A return with missing documentation has no defense. If you receive an IRS audit notice, which the vast majority of people never will, here are 5 steps to do. Step 1. Don't panic. Over 75% of audits are correspondence audits handled entirely by mail. The IRS asks for one document. You send it. That is often the complete audit. Step 2. Read the notice completely. It specifies exactly what item is being questioned and what documentation to provide. Respond only to what was asked. Each additional piece of information you volunteer creates a new potential area of review. Step 3. Gather documentation specifically for the questioned item. Receipts, bank statements, mileage logs, invoices, whatever directly supports that line item. Organized, complete documentation resolves audits fastest. Step 4. Meet every deadline shown on the notice. IRS deadlines are firm. Missing them results in automatic adjustments against you and the loss of your appeal rights. Calendar every deadline the day you receive the notice. Step 5. Consider professional representation. For complex or in-person audits, an enrolled agent, CPA, or tax attorney typically achieves significantly better outcomes. Know your rights. irs.gov/taxpayer bill of rights. Your complete audit trigger quick reference. The 10 red flags. 1. Unreported income. IRS auto matches all 1099s and W-2s. 2. High income. Risk rises sharply above $500,000. 3. Large Schedule C deductions. DF score comparison. 4. Multi-year business losses. Hobby loss scrutiny. 5. Excessive charitable deductions. Appraisal rules apply above $5,000. 6. Home office. Must be exclusively for business. 7. 100% vehicle use. Contemporaneous mileage log required. 8. Crypto transactions. All sales and trades are taxable events. 9. Round numbers. Signals estimates, not records. 10. Prior audit history. Consistent compliance reduces risk over time. Not filing. The single biggest trigger of all. How to stay protected. Report every dollar. Document every deduction. Use real amounts, not estimates. Maintain written mileage logs. Verify crypto on Schedule D. Keep all records 7 years. And file on time every year. File accurately. Document everything. The best audit defense is a return you can fully support. That principle, applied consistently, is the entire difference between a taxpayer who dreads IRS contact and one who can respond to any notice with confidence. Subscribe to Gold Cipher for new financial intelligence every week. More content is coming. Subscribe so you never miss a video.